Thank you for joining today's webinar on balancing headline risks with investment opportunities in China. My name is Hank Kim, and I'm the Executive Director of NCPERS. Today's program is part of our expanded Center for Online Learning. As we're all adjusting to the new COVID reality, we ask you to bear with us if there should be any technical issues or an errant background noise during our webinar. As always, your patience and understanding is appreciated. We encourage audience participation, so please submit questions by using the GoToWebinar portal. However, to ensure that we can cover all our topic today, we will hold your questions till the last part of the program. Today's webinar is sponsored by Allianz Global Investors. To introduce the firm and our presenter today, we have with us JP Vicente, who heads the institutional marketing for Allianz Global Investors in North America. JP?
Thank you very much, Hank. Thank you, and many thanks to all of you for connecting with us on this webcast today. Allianz Global Investors is very pleased to support public pension plans and NCPERS in particular. We hope you and your families are all safe and healthy during these difficult times. We'd also like to express our gratitude to all those workers on the front line of the COVID-19 pandemic, from healthcare professionals to first responders and to everyone else keeping our supply chain operational. So a big thank you to all. As we all know, in addition to the health crisis and the personal toll, the COVID-19 pandemic has also upended financial markets and prompted massive fiscal and monetary response from governments worldwide. It is in this context that I would like to discuss the topic of the webcast today: the state of the Chinese equity market, specifically the domestic A-shares market, and whether or not it presents an opportunity for investors to re-risk portfolios today. Well, we'll cover several topics, from the current state of the economy and the fight against COVID-19 in China, to how the equity markets and the government have reacted to the challenges presented by the pandemic. But before we get started, I'd like to introduce you to our speaker today, Christian McCormick. Christian is a senior product specialist with Allianz Global Investors and has been with the firm since 2015. Christian works very closely with our investment professionals in China. He has on-the-ground experience as he used to live in Hong Kong and is responsible for representing our China equities platform in North America. He has 21 years of investment experience and is a CFA charter holder. So Christian, thank you so much for participating in the webcast today, and we're really looking forward to hearing your thoughts and your insights. Before I pass the baton on to our speaker, however, let me just give you a little background on our China equities platform. Allianz Global Investors has had local offices in Asia for over 30 years now. We have been operating in the China A-share markets of Shanghai and Shenzhen for 15 years, and we have had a dedicated strategy since 2009. Our China A-share team is based in Hong Kong, and they had roughly $3.5 billion in assets under management as of March 31st, 2020. So now, without any further ado, Christian, the floor is yours.
Great, thank you so much, JP, and thank you, Hank, and thanks to all of you for joining. We'll go ahead and jump right into the presentation. So I wanted to start with just kind of an overhead view of US-China relations. So our view has always been that there will be a longer-term tension, is probably the best way to describe it, between the US and China. And that is primarily driven by their different geopolitical aims and current positioning, and also being the two largest economies in the world. But China is still at a very different stage of its economic development than the US is. And we think, as highlighted on this slide, that things such as the trade deal aren't going to be a solution to this tension. And it is just a manifestation of one of the many smaller battles that are going to occur due to this overlying tension. But we also believe that this tension can mask some powerful investment opportunities within the domestic Chinese equity markets. And it's important to separate those two things and not ignore some of these investment opportunities just because some of the headlines may be unfavorable to one or both of the countries. Okay, so where are we today? So both in 2019 and year to date, we've seen that the China A shares have outperformed other major equity markets. So a quick and important point of definition here, just so we're all on the same page, is when we're talking about China equity. So if you look at a mainland Chinese company that is domiciled there in the mainland, it really has three different areas, or venues, I should say, in which it can list its stock. You have the A share market, and those are the local Shenzhen and Shanghai stock exchanges. So those are called the A shares, or they're also referred to as China onshore. And then the offshore China category, which you see on this page in kind of that light purple color, that refers to the Chinese domiciled companies that are listed in Hong Kong on the Hong Kong exchange. And they are listed with H shares, so H for Hong Kong. Or they can also have depository receipts at major markets all around the world. Now, the US ADR portion of this dominates that China offshore market. So there are some in Singapore, now London has its own options, but really we're talking about the US ADR market. So if you think, or if you see a reference to offshore China, that is the combination of these H share listed securities and these ADRs. So we'll call that offshore, and then China A shares, which we'll call A shares or onshore, and will be the primary focus of this presentation. So going back to this slide, you can see the A shares had tremendous outperformance in 2019, almost doubling the performance of the regular emerging markets index. But then year to date, even though this is about a week old now, the China A shares have also had a much shallower downdraft than other developed nations, including the US. And if we flash forward to today, an update on performance, that is still the case. In fact, the China A shares are very close now to breaking even in terms of their year-to-date performance on an absolute basis. So why have they had this outperformance? Well, there's lots of drivers, of course, to equity returns, but really in this current environment, we think we can distill it to three main categories. There's, of course, the spread of the COVID-19 and the containment measures around it and all of the news surrounding that. That has been a significant driver of equity returns at the market level. And then, of course, you have the economic environment and those fundamentals, and the capital markets environment and those fundamentals. So let's tackle the notion of the effect, of the spread of COVID-19 first. So if we look now at that same year-to-date performance, and now I'm just breaking it down into daily performance so you can see the journey that each of these indices have taken. And you can see that China hit its peak cases with COVID-19 back in early February. And that actually came after their Lunar New Year, and the Chinese government, they usually have a few days of a holiday. They extended the market closing to a full week. And we think this had a little bit of a calming effect on, in particular, the retail or domestic Chinese investors, in addition to perhaps some foreign institutional investors as well, that may have actually helped the market in terms of its down performance. But it did open down right after those markets opened, but then it proceeded to move upward. And we think that that upward movement through the end of February and beginning of March was primarily due to the fact that China is perceived to have the spread of the virus almost completely under control. They're now worried about second waves. They're worried about kind of closing out pockets. But in terms of the main issues around the rapid spread, having the hospitalization capacity, and also, unfortunately, the fatalities that accompany this pandemic, they are much further ahead than, of course, the developed nations are. And we think that was reflected in the performance. But as you can see, the A-share markets did take a bit of a dip as well towards the end of March. And we think that was the realization that the overall global market is going to go into a recession, perhaps a very sharp one, and perhaps one that's elongated. And so, of course, the Chinese economy is going to be affected by that. And then there were also questions as to just how quickly Chinese companies were going to be able to ramp up in terms of employment, production, everything that's associated with the lockdown. Once that gets lifted, how fast they could get back up to speed, so to speak. But even considering all those factors, you can see that the A shares are still never really had as much of a downdraft as the major developed markets did, and especially in other emerging markets if you take China out of those emerging markets calculations, which is that gray line at the bottom. So now just a few charts on the virus itself. So you can see exemplified here on the left-hand side, we're looking at overall China, ex-Hubei, and the Hubei province is where Wuhan is located, and Wuhan was the epicenter. So even taking that out, which tends to skew the numbers a little bit, we can see that both on the left-hand side and then the right-hand side, which does include all of the Chinese provinces, that the peak did happen in early February. And perhaps most importantly, it has tapered off very quickly. So for us, it's not really important to look at or discern too much as to how accurate the numbers are coming out of China. It's perfectly reasonable to question their official data. It's more the pattern or what we're seeing in the trend. And the trend certainly exemplifies a very fast drop off in how much the COVID-19 was spreading and how quickly China got it locked down. All right, in addition, as we stand today, some positive statistics around this. So among about 3,000 rough county district level regions in China, only one of them is labeled as high risk, and risk being defined as the spread of the virus, the rapid spread of the virus. And only 12 is medium risk. The rest of them are actually all ranked as low risk. In addition, China has instituted multiple layers of formal testing. I think what the US is on its path towards doing at the factory level, at building levels, building entrances, kind of apartments, condos, commercial buildings, parks, even broader neighborhoods defined in certain ways. There's testing multiple times a day for multiple individuals. In addition to that, individual Chinese actually have to have on their mobile device, they have an individual QR code. And that QR code is either green, red, or yellow. And it can be scanned by the testers or by like police officials and so on. And basically the color of that code is dependent on tracking where you've been. Now that's very draconian step. I don't think we would ever get to that stage in the US, but that is what China has done. And in this case, it's been effective in that it's basically telling if you've been near high risk areas or even a high risk neighborhood or even a high risk building. That's kind of the level of categorization that they've broken it down to. And your QR code will respond with that type of color. And then further steps will be taken if you're yellow or red. And then finally, China has significantly restricted entry into its borders, national borders, in order to reduce the possibility of having a second wave driven by someone coming from outside of China, right? So there's quarantine and daily testing that's involved at the initial entry point, and then at your final destination, some additional quarantine and testing steps are taken. Okay, so that's basically, to sum up, is that the virus aspect of the effect on capital markets is really under control in China. And we think that that has been a positive tailwind for its markets overall. And there is some credence to that when you look at US markets and you see how our markets respond to things like positive news about the vaccine, that New York hopefully continues to be on the downtrend in terms of fatalities, hospitalizations, flattening the peak. The market responds very favorably to these things, and the Chinese A-share market did the same. It's just they hit those positive news metrics a little bit sooner than we did. Okay, so what is the current economic environment? So quickly, as most of you know, China has become the second biggest economy in the world. In addition to that, over the past 30 years, it was responsible for almost a third, a little bit more than the overall GDP per capita growth. So it has been the engine of global growth, much more so even than the United States over the past 30 years. And as we saw with the official numbers coming out, that China did in fact go through a fairly dramatic contraction in 2020 in the Q1. And when you compare that to what was fairly consistent annualized GDP numbers on a quarterly basis of 5.5% plus to say 6.5%, this was a dramatic step down. So China certainly was not immune from an economic standpoint. Their lockdown was very severe. And the numbers look worse than Europe and the United States GDP in particular, because again, they started their lockdown much sooner. So it really encompassed almost the entire first quarter, whereas for the United States and Europe, it was more of a mid-February and on happening, really just March for the most part. And what we're showing here are GDP forecasts. Now, these are year-over-year forecasts. So you're looking at the GDP for the entire year. The dashed line is where the average of these forecasts of a group of economists were on April 3rd, so about a month ago. And then the solid line is the most recent forecast that we've seen. So you can see that all of the GDP forecasts have been revised downward, really across the board, across all major regions. But importantly, even with that big first quarter downturn that we saw in China, the expected GDP for 2020 is still positive. It's much lower than the rate it's been going at, that 5.5 to 6.5% GDP growth. Overall GDP growth was expected to slow down a little bit this year anyway, but relative to other countries, so if we're looking at this as a relative game, especially, China is in much better shape. So it had a much stronger GDP growth in the first place. And of all the major regions, it's the only one that is still expected to have positive growth overall for 2020. And we think that's buoying the market somewhat, excuse me. In addition to that, some other statistics. So we've seen the massive stimulus plans that have been instituted in Europe and the United States. And in China, they have also instituted fairly large stimulus, but nowhere near as large as we've seen in this country or in other major regions, and nowhere near as large as what China put in place going back to the global financial crisis. So China has been much more, I think, methodical and constrained or practical, I would say, about their stimulus this time around. They don't just want to saddle the country with enormous amounts of debt, and they're trying to be much more targeted and be much more patient and kind of see as the economy moves along and gets back up to speed and these lockdowns are lifted, where they might have a little bit more of a surgical approach in terms of stimulus. It is important to note that they have a lot of ammunition kind of in reserve that they can deploy in this case, and we think that is a positive. So the National People's Congress, which is their major legislative action, was postponed from March to May. That's going to take place towards the middle of this month. And we think that will probably be where they make some big announcements around some infrastructure stimulus, in addition to some other programs that we do actually think will happen. And we think that will be a positive, but it's very much in kind of the Chinese way of doing things, of waiting for an opportune moment to make a big announcement. And we think they'll wait for the National People's Congress to do that. But overall, it's a positive in that there's still a lot of stimulus they could deploy. All right, some other statistics that we saw is in March, manufacturing started to ramp back up quickly, employment started to come back up, some other indicators such as property sales growth, traffic congestion, pollution, power use, they were slightly down versus their same numbers of last year, but they still had ramped up very quickly versus the contraction that they saw in late January and February. And in April, although the pace of it has slowed down somewhat, it is still in a positive trajectory. And in addition to that, because you always want to have a secondhand view of that official data, is we have a lot of on-the-ground research that we do at Allianz that's actually proprietary to us, where we want to talk with these business owners, entrepreneurs, manufacturers, actually get in there with surveys and live interviews to see if what we're hearing on the official level, if that makes sense from what we're hearing from them. And in this case, it did. And then finally, what came out recently, from another economics firm, was a survey that the US Chamber of Commerce did, and this was last week, and they did it over the span of the entire week, and they simply asked, when do US businesses that have significant operations in China expect that their supply chain will be back to normal? And remarkably, over 2/3 thought it would be in less than 3 months, and 96% overall thought it would be within 6 months. So even outside of the official data, there seems to be a theme or a thought with US businesses that China is getting back up to speed and back up to normal from an economic standpoint quickly. And we think that's a strong tailwind. Okay. A few other characteristics about the A shares in particular. So although China will be affected by the global economic downturn, it's important to note that A shares only derive about 10% of their revenue from outside of China. And that's very important. So China A shares are very much a domestic China economic play, a domestic China consumer play. That's primarily the types of businesses and operations that the China A-share market represents. And so even though China overall has been less dependent on exports year over year, that's even more the case for the China A-shares in particular. And so the global economic recession should have a little bit less of a negative effect on A-shares than on the H-shares and some of the US ADR listed companies. Okay, and now a few perspectives from that capital markets point of view. So you have some good news around the virus. The economic situation is better. In fact, if I could summarize it best, I would just say that the probability of a V-shaped recovery and a sharp V-shaped recovery is greater in China than elsewhere. So still a lot of question marks, still a lot of uncertainties, but China is expected to fare better from an economic standpoint versus other developed markets, and certainly more so than some emerging markets, and that's been a tailwind. So now looking at the capital markets tailwind, there's a few interesting aspects I wanted to point out. So we've heard lots of headlines in the US about the effect of share buybacks and how that has hurt the liquidity positions of some of these companies because they use debt in the US to have the capital available to either pay dividends or institute these share buybacks. So I took a look and I wanted to quantify what this effect was. So using data from S&P and a firm called Win, which is a big data provider for China, took a look back and developed this buyback as a share of market cap yield indicator. So it's simply the volume of share buybacks within S&P 500 companies only, which is the turquoise bar, divided by their overall market cap. So you can see that it's been a fairly steady 2.5% to 3.5% rough range in terms of the volume of share buybacks. And that's a fairly significant source of demand to just take away from the markets right away. In addition to that, there's of course the EPS manipulation that you get from a share buyback by taking the number of your shares outstanding to try to make your earnings look better. And that aspect or this characteristic just has not been existent in the China A-share market. Buybacks have increased recently, which we think is a positive because of some lifting of some capital markets restrictions within China. But overall, it's nowhere near the level that we've seen with the S&P 500. And so we think that was an overall positive because there was no, quote, buyback rug to pull out from underneath the China A-share market. And then from a valuation perspective, just taking a look at a few characteristics, so a forward PE ratio and also a price to book ratio, you can see that even after the big run up in 2019 and the relatively shallow downdraft that we've seen here year to date, is that from a valuation perspective, China A shares are still trading well below their historical 10-year averages and significantly below the similar metrics that we're seeing for the S&P 500. So you look at that 11.5 versus 18.3 for the forward PE and a price to book of 1.8 versus 2.9. So from a valuation perspective, the Chinese A share had a lot, hadn't climbed as high, so to speak. So it was much less of a fall down from the top, contrary to what we were seeing in the US markets, which were already perceived as being somewhat frothy and overvalued overall. So these were really the three main drivers as to why the China A shares have held up well year to date, but should also turn into good tailwinds going forward for investment the rest of the year. Okay, so now let's take a look at the actual China A share market and some of the interesting characteristics we see there. So the reasonable question is, all right, it's outperformed year to date, but is this relative outperformance something that's sustainable over the long run? And does this present a good opportunity to re-risk in portfolios? Meaning, have I missed something, or what exactly is the benefit of China A in adding to my overall investment portfolio relative to other markets? And we think the answer is unequivocally yes to both of these. So first, let's just take a look at historical performance for the overall A share market. Now, this isn't back to inception, but this was something that I always thought was interesting, as I'm certainly not the first person that you probably heard saying, yes, China is a great place to invest. We've been hearing it for a long time now, mainly predicated on this economic strength, this expansion of the Chinese middle class, this incredible economic growth. China is going to be a great place to invest in equities. Well, if you look at the A share market over the last 10 years, that has simply not been the case. You are looking at an annualized return of a whopping 90 basis points. That's it. And you compare this to the S&P 500, even with the big downturn in the first quarter that the S&P 500 had, and it is significantly underperforming US equities. And it is barely ahead of emerging markets more broadly, and it is actually underperforming emerging markets over the trailing 5 years. So why is there this disconnect? Why have the markets within China, the A-share market in particular, not done as well or haven't reflected this spectacular economic story that we've seen, and what has changed recently? Well, so there's some economic reasons for it that I'm not going to get into in this presentation. That most of the economic growth originally was driven by government spending. There was a lot of inefficiencies with how institutional investors or foreign investors broadly could even access the China A-share market. And so because of that, we think today the economy is on a much better footing in terms of its breadth, in terms of the number of private enterprises, in terms of how old its capital markets are finally, in terms of the foreign institutional investor participation. Those are all positives. But one aspect that I don't think gets enough attention that should is the fact that the Chinese equity markets are very young. So really the Shenzhen and Shanghai stock exchanges were launched in 1990 and 1991. So you were looking for a little bit less, than a 30-year history for these stock markets. And we have individual US companies, legions of them, that have existed as stocks for longer than that time period. So these markets are still very young, and I don't expect you to read through all of these little bubbles that I've attached to it, but I mainly put so many on there to show that the Chinese government has been very busy, very involved in making tweaks, enhancements, adjustments, trying to figure out the balance of their economic policy and how they want the capital markets to behave. And there have been some fits and starts to this, but we think this is a big driver into why the A shares haven't responded more broadly. In addition to that, foreign institutional investors really weren't allowed to invest in large quantities until 2002, which was the launch of a quota system. And then that was further established in 2011. But even there was a restriction on how much you could invest, and there were numerous other very onerous rules and regulations around when you could get your capital out, how long you had to have for a holding period, how rapidly you could trade, even the size of your profit, in addition to just costs for setting up the account, how the Chinese government monitored it. It just was very investor unfriendly relative to what we're used to in the more developed markets, especially the US and Europe. And that really all changed in 2014 with the launch of what we call Stock Connect. So Stock Connect is an important mechanism, so I'll spend a little bit of time on it. But Stock Connect is where, as a foreign institutional investor, you actually invest into China A shares via the Hong Kong Stock Exchange. So just think that if I'm an investor, I have an account with the Hong Kong Stock Exchange. My buy and sell orders are routed through that exchange. They then go into the mainland to the Shenzhen and Shanghai counterparts on the other side through brokers working with that exchange. And then all of the settlement and the clearing takes place between the two exchanges. And that really significantly ramped up the interest from foreign institutional investors into China A because there is a long storied experience and comfort level that foreign investors and asset managers have in dealing with the Hong Kong Stock Exchange. From when it was a British colony, it's a very developed market, extremely developed market. So because of the familiarity, because of the rule of law, because of the comfort with the institutions and the strength of those institutions on the Hong Kong side, that Stock Connect really served as a catalyst to increase the interest of foreign institutional investors. And in addition to that, China made some great strides in adjusting things like the repatriation of profits, the cost of setting up an account, ownership periods, things of that nature, made it much more investor friendly. And so with the launch of the Stock Connects, and also that coincided with MSCI beginning their inclusion process, in which they wanted to begin including China A shares in their indices, the two big ones being the MSCI Emerging Markets Index and also the MSCI All Country World Index. But the Emerging Markets Index, is the one that's gotten the most attention. And I'm going to touch on some of the specifics around that inclusion today, which we think is a big tailwind in a few slides. Okay, so moving on to the next slide, just to give you an idea of where A shares stand relative to other markets, you can see that the A share market represents about 8.6 trillion in market cap and has about 3,800 names, 3,900 names. The H shares have 3.4 trillion or 1,200 names. And then the US ADRs are almost about a trillion and about 126 different listings. So when you sum all of that up, the equity investment opportunity for domestic Chinese companies is almost half of that of the US market. And for the US market, I'm actually using the Wilshire 5000, taking out their microcap index, which is why it's only 3,800 stocks. But it gives you an idea that it's of a significant size. It's bigger than the entire Euro area in terms of market capitalization. And there's a higher number of stocks that you can invest in relative to the US at about half the potential market cap. So it's a very developed market, but you begin to get the notion that this market is somewhat underrepresented in these major indices and also in most institutional investor portfolios. So going back to the idea of the inclusion, you can see it started in 2014, and MSCI basically set forth a very methodical path of incorporating a greater and greater amount of China A shares formally into its index. And the last inclusion step they took was in November 2019. And at that stage, China A shares represented 4% of the index, and China Offshore was 30%, Offshore again being the H share and the US ADRs. At this point, the inclusion process is paused. It's expected to continue, but what MSCI is doing, is they've laid out some stipulations around things like the ability to hedge your position via derivatives market, which really doesn't exist to this point. Things like omnibus trading and multiple accounts, settlement periods, some other things they would like to see the Chinese Securities Regulatory Commission, which is the arm of the government, kind of their equivalent of the SEC, move on before they start to include a greater number of A shares. All right, so what that looks like today is, because the markets have had a better performance year to date, about 5% is in China A shares, and about 36% is in the offshore markets. So remarkably, China alone makes up 41% of the MSCI Emerging Markets Index, and that is only expected to get bigger in terms of the A share portion of that. But importantly, if you look to the right, the composition of the two markets is very different. So A shares has a much smaller percentage of these big mega cap type stocks. Think of like a Tencent, an Alibaba, Baidu, JD.com, some of these more familiar names, and they have a much better breadth across the large cap market and mid and small cap names. So we think it's a much more fertile ground just in general for equity investing overall than the offshore market is. Okay, the sector breakdown, just to give you an idea of how these are broken between the major domiciles or listing domiciles. So you can see that Hong Kong tends to see most of the utilities, energy stocks, real estate, financial, communication services. So another way to think of it is these tend to be the big mega cap central state-owned enterprises. They do tend to list in Hong Kong, whereas where we see a lot of the growth areas or really interesting investing concepts in China, that tends to be better represented in China A. So industrials, consumer staples, IT, and healthcare there in the middle tend to be dominated from a market cap perspective within the China A share market. And just seeing a different way, that market cap breakdown, you've already seen that on the right-hand side, but on the left-hand side, looking at it in terms of the number of stock issue, we see that in every single category except for real estate, there's a greater number of stocks per sector to invest in. Even though market cap may be dominated by the Hong Kong listed stocks, in terms of breadth or investment in availability, that is dominated, by the A-share market in each of these sectors. Okay, there's always a question with China about state-owned enterprises, and rightfully so. But it's important not to paint state-owned enterprises with a very broad brush. You need to look at them really in two distinct ways. One is, what type of SOE is it? Is it a central SOE? Think of that as kind of our federal government level, or is it a provincial or locally owned state-owned enterprise? Because the two tend to behave very differently from each other in aggregate. And then also you need to ask, is this a strategic SOE or a non-strategic SOE? So it's important to remember that every company was a state-owned enterprise at some point, right? China is developing its private markets. It has made incredible strides, but really everything was an SOE. So it has to transition out of that. So in every sector that you see, it's not surprising that there are state-owned enterprises in consumer staples, in healthcare, in investment technology, in consumer discretionary, right? It's not just these big, more central type SOEs in financials and energy and utilities. So with the central versus provincial and local, the central SOEs truly are instruments of the central government in terms of their economic policy. They're going to use the banks, the energy companies, the big national champions, primarily to facilitate their economic policy. And therefore, earnings and a profit motive are absolutely going to be a secondary consideration in most of these instances. That doesn't mean that there aren't individual pockets of good investment opportunity, and we've gotten some nice returns from central SOEs, but you have to be very careful and do a lot of extra kind of corporate governance due diligence when you look at these companies. That's very different than provincial and local SOEs, which in aggregate tend to be much more capital markets oriented. So they are paying attention to profits. You know, they do look at earnings. They do look at how they manage their balance sheet relative to the health of the company itself. They do want to grow the company. So they tend to be a lot more Western oriented. And the same breakdown occurs with strategic versus non-strategic SOEs. So you can imagine that a centrally owned consumer staples company isn't quite as important to the central government as, say, a bank may be to implement the stimulus policy and other aspects of what the Chinese government is trying to do. So we find a lot better investment opportunities in these non-strategic SOEs at every level. So a lot of information there, but I just think the important takeaway is that you don't just kind of instantly recoil from seeing a state-owned enterprise and think that it's a bad thing. We've had generated quite a bit of alpha in our portfolios from a lot of our state-owned enterprise portions of that. Okay. So on this slide, there's also a very strong diversification argument to make, and that may have already become evident by the nature of the type of stocks that you see in the onshore market versus the offshore market in terms of market cap, number, and index, or sorry, sector domination. So this is a 10-year correlation study, and we actually update this every month, and we haven't really seen a significant change. And if you look across the top line, you can see that the China A shares have very good diversification benefits relative to other major equity markets. So very low diversification versus developed markets, but also surprisingly, you can see that they have a 0.6 correlation there to their H share listed stocks. So these are still the same Chinese domiciled companies, but the way that the stocks behave tend to be different in the A share market versus the H share, the offshore market. And we think that's a diversification opportunity and another strong incentive to look at A shares as kind of its own separate asset class or a separate type of investment. Okay, and if you look at the year-to-date daily performance of these three categories, so the blue is MSCI China, the orange is the MSCI China H shares index only, and the gray is the MSCI China Overseas Index. So this is really just ADRs. Now of note, just want to be upfront here, that ADR index is dominated by Alibaba. Alibaba is a whopping 62% of that benchmark. So I wouldn't really call it a well-diversified benchmark. And then Tencent, Baidu, JD.com are the other major holdings there. So very concentrated, and it's really all about Alibaba. But still, you can see that these three indices, although they're tied to the domestic Chinese economic story, some more export driven or exposed than others, yes, but still they follow very different paths in terms of their performance. So this just adds to this notion that we think there's this great diversification opportunity from owning China A as a separate asset class, especially because the H shares and overseas are already well represented within the overall emerging markets index currently. If you go back and remember, there's 36% of the EM index is in these overseas and H share stocks. So most investors are already going to have exposures to those stocks in their standard portfolios, and where they're probably underweight is in the A shares in particular. Okay, so on this slide, really the important message here is that the level of foreign institutional investor participation has really skyrocketed. So on the chart on the left and the far left above November 14, when the Stock Connects were launched, you can see that the foreign institutional participation has ramped up quickly, and Stock Connect has become far and away the most effective and popular tool for foreign institutional investors to access this market. But at the same time, even though this investment has been rapidly growing, you can see on the right-hand side that as a percentage of turnover, it's still in the mid-single digits. And that is because the A-share market is still driven by retail China investors. They're the predominant force behind the liquidity, behind the trading volumes, and behind the market capitalization. And it's also one reason why the markets are so volatile overall in China A. So we actually think those big swings in volatility are an investment opportunity, but we think as more and more foreign institutional investors enter the market, the volatility should start to come down, and we should start to see a little bit more of a calming effect on the market overall, but it's still very much a retail-driven market at this stage. Okay. And then finally, just a few slides here in terms of how individual sectors tend to perform. So as evidence of this idea that it's a retail-driven market, you can see that there's rapid sector shifts that go on within the China A-share market in terms of leadership. So this is a heat map showing the top performers and the bottom performers, and then performance throughout based on color. And it's not only that the sectors in terms of who's outperforming and underperforming rotate quickly from year to year, it's also the magnitude of returns that you see is tremendous and significant. And that is something to be very wary of as an investor. And you can have approaches like ours where we tend to be more of a sector neutral approach just because we believe that there's so much alpha in the stock selection piece of it. But you do have other asset managers whose approach is to try to time these sectors. And the reward can be much bigger, and of course the penalty will be much bigger as well. But that's the best way that they see to approach the market. And so you see year to date, at least through February, this really continued in March. As you would expect, information technology, just like in the US, communication services, consumer discretionary, these were the sectors that tended to hold up healthcare better with that year-to-date outperformance that we've seen so far. Okay, and then really the last slide I'm going to cover, because I think it's an important one, even though it's a very simple illustration, is yes, investing in China A shares is about that domestic consumer. It's about an expanding middle class. It's about exposure to a great economic growth story. But another staple of this, and we think it's a pillar of what makes this such a good investment opportunity, is what you see represented on this chart. So this theme of domestic replacement of foreign brands, if you kind of do a before and after picture in your mind, right? Before, China used to be incredibly an export-driven economy, right? They were the makers of supplies, kind of low-end supplies on the supply chain. You know, that phrase "made in China" was ubiquitous on all the products that we had, but a lot of them tended to be lower-end, lower quality products, and China is well aware of this. And so the Chinese government set out on a very methodical, disciplined path of changing that equation. And they wanted numerous industries, or to have, domestic Chinese companies within numerous industries be equal to or better than the foreign competitors across the entire quality spectrum, not just at the low end. And this is a perfect example of that. So you actually see that Nokia, Motorola, Sony used to dominate the smartphone market. Then some China domestic brands were at the lower end, low price point, low quality, started to dominate. And then Apple and Samsung came into the market as well. And then you see how quickly Huawei, Oppo, Xiaomi, and Vivo have taken market share, both from foreign competitors and the lower quality and Chinese domestic brands. And you can take this chart and you can overlay it on home appliances, you can overlay it on heavy machinery, you can overlay it on transportation equipment manufacturing. In other words, this move by the government to have Chinese companies be the equivalent or better than foreign competitors throughout the quality spectrum has been realized in many industries. And so we think this is a big positive for the China A-share market. And the next industry that the government has really set its sights on is the semiconductor industry, because China has great ambitions in terms of AI technology, 5G and 6G technology, and some others. And so we think semiconductors will probably have a picture that looks like this very much in the near future. Okay. And then just a couple slides, really I won't spend that much time on these in the interest of time, but you can see that from that technology standpoint, the number of 5G and 4G patents that China has far exceeds what we have in the US and even other technology powerhouses such as Taiwan, Japan, and Korea, both in 4G, but especially in 5G technology. Right. In addition to that, we see some very interesting investment opportunities in things like online healthcare, online shopping, online tutoring. So the same type of sectors that we're seeing some positive news about here in the US as remote working picks up, a lot of these were already present in China, and now they've just picked up the pace because of the lockdown and have gained in greater popularity. And we've seen some good investment opportunities here accordingly. All right, and with that, we'll actually end the presentation and wanted to turn it back over to Hank and open it up for any questions, please.
Thank you, Christian. Christian, question regarding slide 35. You mentioned the semiconductor could be overlaid with that chart. There's a question about maybe, I guess, content. So like, the film industry or software, how would that fit in?
So the film industry, that's a little interesting. We don't see great investment opportunities there in terms of specific Chinese companies. So Chinese are still big consumers of US content and European content, and you tend to see the bigger players and actually more offshore players like Tencent and others have kind of film production arms or entertainment arms that they're utilizing, and they're dominated in that space. So I mean, a good way to play that is a company like Alibaba or Tencent and some others, but then you have to kind of accept some of the other investment opportunities there. So we don't think that's really a matter of replacing a foreign competitor. We just do expect to see an increase in Chinese-made productions and Chinese money, perhaps financing US productions, but kind of in the same way as the Bollywood, right? In India, that is a very robust film and entertainment industry that grew on its own, and it still exists kind of not in harmony, but not competing directly with Hollywood. So some Hollywood movies are in India, some Bollywood movies have made their way over here. We think it'll be a similar story with China. Software, it's a little bit more mixed. So on the services side, depending on what you want your software to do, say, tax preparation software, or other type of services-oriented software, that tends to be mixed in terms of foreign competitors versus Chinese. So I would almost say that that's kind of in the 2014, 2015 type range. There aren't some really dominant players yet on the Chinese side in terms of the finished software product that we see yet. So we think eventually that will be the case, but that is not really a priority of the Chinese government. In addition to semiconductors, renewable energy is a huge component of the Chinese government's push. They want to be the leader in wind technology, very much so in solar technology. In addition to things like hydrogen fuel cells, electric vehicles, they're way ahead of the curve. So with semiconductors and that in particular, we think those are really the primary two areas of advancement. And the semiconductors is really driven by more the end product usage. So if they want to be high in the ranks of artificial intelligence applications, things like electric vehicles, right? 5G technology with mobile technology, then they have to ramp up their own semiconductor to meet that goal. So sorry, a little bit of a long-winded answer there, but that's kind of where we see things stand.
Oh, no, not at all. So in terms of sort of lessons learned regarding China's fiscal and monetary policies, now versus 2008, 2009, what do you think they're doing well, and where do you think they need additional improvements?
So where I think they're doing well is on the restraint that they've shown. So 2008, 2009 was really just a massive heaping of debt at all levels onto the market just to kind of hyper stimulate and monetize their way out of the global financial crisis. And it worked very well. And I think part of the reason why it worked very well is because China was still at a younger stage in terms of its economic growth. There was still a much more powerful lever that the Chinese government could pull in terms of stimulus with commercial property construction, residential property construction, and very much infrastructure. So if you go back 10 years to that time, probably a great highlight is their high-speed rail. So 10 years ago, China did not have any high-speed rail at all. And remarkably, as it stands today, they're going to have, at the end of this year, approximately 29,000 kilometers of actual high-speed rail line. And that is a remarkable change over just a 10-year period. I mean, they're creating they're developing now, or manufacturing, I should say, their own trains. And that's kind of an example of this big infrastructure push that they've gone on. But the difference between, say, 08 and 09 and now is all of these big gleaming new airports have been built, right? They've facilitated kind of airline manufacturers, the high-speed rail, much of the lines have been built. So a lot of the, I would say, lower hanging fruit that you can pull as a government from an infrastructure perspective have already been pulled. And so they've had to be a lot more targeted with this stimulus. And it's been more difficult for them because now when you have private enterprises, right, when you're trying to stimulate investor consumption, when you're trying to stimulate or provide lifelines to small and medium-sized businesses that are private, when the mechanism that you're doing that are massive state-owned banks that primarily have good relationships with massive state-owned industrial companies, energy companies, utilities, is that the small and mid-sized companies can tend to fall by the wayside a little bit. So I think what we're going to see is we'll still see infrastructure spending. There's always more you can do there, especially on the renewable side or energy resource side, but you're going to see a lot more stimulus come in the form of targeted loans and stimulus to foster consumer spending, and also to make sure that small and mid-sized enterprises do stay afloat in this difficult time. I mean, kind of an interesting example is that provincially, the central government through all their provinces orchestrated this coupon type stimulus, which was interesting, but it actually worked, in which on your phone you got a set of coupons, or you could kind of register to get a certain number of coupons, and they weren't very much in value, maybe $4, $5 equivalent, but they were only for restaurants. They were only for some, say, retail stores that had been shut down. And the idea was if you spend $20, then you can use this $5 coupon. And that was the government's way of trying to stimulate consumer spending. And it actually worked very well. There was a significant multiplier effect because of those minimum amounts and because of the desire to go out and go shopping and go to restaurants again with the lockdown lifted. But that's kind of an example of the very surgical type stimulus that just wouldn't have even been thought of in 2008 and 2009, that they're doing better this time around.
Christian, last question. So I believe it was in the first quarter of your presentation, you had confidence that China would be one of the few regions that would rebound in the second half. What are the risks to that forecast? And as you're talking about the risks, could you also talk about sort of the perception, at least pushed by some in the federal government, particularly the administration, about the blame for this virus being on China, but more broadly, the notion by even I guess mainstream academics and practitioners saying this example of or this COVID is an example of why this far-flung global supply chain may need to be revisited.
Sure. So a lot to unpack there. So going in terms of risk, there are absolutely risks to this. We think that they're probably in terms of their economic growth and this V-shaped recovery. So it will be very telling in the next couple months. I think we'll get a much better picture from China earlier than other economies, just because in the US and others we're at the early stages of opening up. But that the global recession is deeper and will have a greater effect on China, mainly in terms of, although it's a small component that's driven by exports, it's kind of still there. So if that export piece, especially in the technology sector, which tends to be a little bit more driven in terms of sales and employment of an export-oriented sector, if the global economy takes a bigger hit than is expected, and that saps demand for a lot of Chinese products, then that, of course, is going to have an effect. And then there's also just the idea that there are some aspects of the Chinese economy that are still in contraction mode or haven't recovered nearly close to what we've seen. So passenger travel, of course, and tourism was a big economic driver, just travel within China itself, which is still a relatively new concept for a lot of Chinese, which tended to stay in their own village, city, and province. So will tourism pick back up? Will kind of luxury retail spending pick back up? And that's something where we're actually doing a lot of research. We're talking to retail store managers. We're talking to car dealerships. We're trying to get a much better on the ground sense of how quickly that could recover. So really, I mean, the same type of economic risk that we're seeing in the US is how quickly will demand snap back? And has there been an infrastructure change, or say a sea change, versus just a deferment of consumption? And right now we think in China, it's still more of a deferment of consumption, and that should give us a little bit more confidence that it could snap back. In terms of your other question, listen, even though we've been investing in China since 2009, is we're under no illusions as to, when you kind of go back to that smartphone slide that I showed you, why is it that China has caught up so quickly in terms of that quality spectrum, having their domestic brands equal the foreign competitor brands? It's because there has been some intellectual property theft, without question. It's because the Chinese government forced US companies into these joint venture type relationships. So a US company couldn't just set up shop on their own. You had to have a joint venture, right, with a Chinese company as well. And that inevitably just led to the sharing of technology. There's really no other way to do it. So China has, and I don't think they make that much of an effort to hide this, piggybacked off of the technological accomplishments of other companies to kind of ramp up their own capabilities. Our view there is that's probably something that, whether right or wrong, that's not a decision for me, not a politician, but you should just take advantage of that, right? Meaning that these A-share companies are now very high quality companies because of that. In terms of some of the other headline risks, that just goes back to my notion that I think this tension will always be there. And whether it's another 4 years of a Trump presidency, or if it's Senator Biden who gets elected, for example, we don't really see the tenor or kind of the tone for China changing that much, meaning that we don't think one party is going to be friendlier to China than the other. So we think those headline risks will always be there. That will create volatility. We'll probably maybe even create some sharp contractions, and say the amount of institutional investor participation will probably be on hold. But overall, we don't think it's enough to derail it in terms of an investment opportunity. So, I mean, one slide that I skipped over, excuse me, but is an important one. So here, with these highly liquid markets, this is giving you the path of the China A-share market over time. And I just divided it out in terms of the level of turnover from retail investors and northbound stock connect, which is another fancy way of saying foreign institutional investors. And you can see that both were positive in January, both were actually positive in February. They both were down slightly in March, but northbound stock connect has actually rebounded faster than the retail turnover has in April. So even though there's been a lot of negative headlines at the overall level between the US and China, especially around how much China knew, why it didn't share more information on just how bad this virus was, which I think is a justified accusation, is we still saw a lot of investor interest kind of below that. And so we think it's important to kind of separate those two categories, the US-China relations from the China A investment opportunity. And we still think that the latter is a very strong one, despite the headlines.
Christian, thank you very much for this great presentation today. It was very eye-opening. And thank you to all the attendees for joining us today. Please join us for our next webinar entitled Life on the Other Side of COVID-19 on Tuesday, May 5th. Please have a good weekend and stay safe, everyone.